Hello everyone and welcome to another lesson of our commodity trading workshop. In the first part, I will reveal to you one powerful tool that can provide a material advantage in the markets. In the second part, we will delve right into practice. We are going to build upon the knowledge we have already gained in this workshop and create a simple trading strategy. Before we start, I have to remind you this video is not investment advice. If any financial instruments like futures, spreads, ETFs, options, or others are mentioned anywhere in this video, it's always just for educational purposes. So, let's reveal that incredible tool. It's called COT analysis. COT stands for commitments of traders, and we will explain it in a moment. What is so great about it? Unlike seasonality, which shows us only the past, the COT data presents the current state of the market. But it's far from being the only cool thing. But let's not get ahead of ourselves. Let me explain first what the CFTC stands for. It is a shortcut for Commodity Futures Trading Commission. When we talked about commodity exchanges, I mentioned their strong regulation as an advantage. And CFTC is the institution responsible for enforcing that regulation. It is a federal agency that regulates the commodity futures and options markets. Where does the COT analysis fit in here? When the position size of any market participant exceeds a certain level, the so-called reporting level, the position must be reported to the CFTC agency. The CFTC harvests this data, and luckily for us, they don't keep it for themselves. At least not all of it. They regularly publish aggregate statistics of this data in the COT report. As I said, COT stands for Commitments of Traders. So, what is in this report? We can think about it as sentiment analysis, but not just some sentiment analysis. It is simply the best sentiment analysis. There are many kinds of sentiment data, but these are often harvested like polls. Someone simply asks a group of traders what their opinion about a market is. But markets are not a democracy, or actually it is, just not the one we are familiar with. Instead of one person having a single vote, each dollar has a vote. In other words, the more money you have, the greater the influence you have in the market. The largest players are usually institutions, not individuals. So if you make a poll in a group of 1,000 traders, it might not be representative at all, as their combined share of the market can be smaller than a single institution. The COT report is different. It aggregates positioning data from all the market players, including the institutions that actually move the market. It does not show opinions but money, and money doesn't lie. As I suggested, the COT data contains the aggregate quantity of long and short positions held by different groups of market participants. It is published on the CFTC website every Friday at the end of the daily trading session. But remember, it shows data from the previous Tuesday, not Friday, so there is a 3-day lag. Thanks to the COT report, we can see what the largest players on the market are actually doing with their money. It's like sitting at a poker table and being able to peek into your opponent's cards from time to time. That's why we call this tool an unfair advantage. There are two major groups of players in the market, the hedgers and speculators. Let's analyze these two groups a bit more. We will start with speculators. These are people or institutions who analyze the market and try to predict the commodity price movement in the future. They often behave like trend followers. When they spot a trend developing in some market, they gradually open positions in the direction of the trend. Their only goal is to make money in the markets. They have no interest in the physical commodity. The hedgers are the commodity producers, traders, manufacturers, and users. So people or firms that directly deal with the underlying physical commodity. They have been in the industry for many years, sometimes even generations. Naturally, they know the market very well and have the best information. Imagine a farmer who grows corn his whole life and inherited the farm from his father and grandfather who taught him everything. Such a man has an incomparably better insight into the market than a portfolio manager sitting behind his desk in Manhattan. So, why do the hedgers trade on the exchange when they are interested in the physical commodity? The futures exchange allows them to get rid of the risk that an adverse commodity price movement poses to their business. Their goal is risk reduction, not profit. That's not beneficial just for them, but to all of us. As we said in the introductory lesson, we can buy everyday products cheaper thanks to futures exchanges. The commodity producers and processors can reduce the price risk using futures contracts, so they do not have to reflect it in the price in the form of a surcharge. But the risk can't just disappear, and that's where the speculators step in. They are willing to take over that risk from the hedgers in exchange for a chance to make a profit. Although the general population often hates speculators, the market would not work without them, and all the goods from bread to gasoline would be more expensive for everyone. While the behavior of speculators in the market is probably well understood, it may not be so obvious with the hedgers. So let's outline two examples that will hopefully make it clear. We will start with a thermal power plant opening a long position on natural gas. It needs the gas as power burn to generate electricity, but it is afraid the natural gas price will increase in the coming months, which would negatively impact its profit margins. By buying the futures contract with a distant expiration, they can hedge the future price right now. Assuming the gas price really increases, the company has two options. It can keep the contract until the expiration and take delivery of the physical commodity. The natural gas would be supplied for the same price they bought the contract in the past, which would be lower than the market price at the delivery time. Or the company can sell the contract before its expiration date. And because it would sell it at a higher price, the company netted a profit. It can then buy the natural gas elsewhere and cover the higher costs from the profit it made on the futures contract. Now let's show how it works when the hedgers uses a short position. A great example here is a farmer growing corn. He needs to plan his expenses carefully due to variable costs like fertilizers, seeds, diesel, etc. But he is worried that the corn price will fall. He hedges himself by selling a corn futures contract. Once again, the farmer has two options. If he holds the contract until expiration, he will have to deliver the corn, but he would do so at the price he sold the contract for, not the market price. Alternatively, he can buy back the contract before expiration and sell the corn on the physical market, using the profit from shorting futures as a cushion. These two examples outline the utility of futures trading for producers and consumers of commodities. You can access the COT data directly at the CFTC website. The problem is that these are huge tables. The entire COT dataset has tens of columns and countless rows. It is not human-friendly and looks more like a mess. Luckily, the Spreadchart app allows you to access the process data in nice-looking charts, so you don't have to go through endless tables. There are more types of COT reports containing more than just two groups of market participants, but our goal is to simplify things as much as possible. We have partitioned the data in two major groups, the hedgers and speculators. As the name implies, the hedgers represent the most important group of people and institutions dealing with a physical commodity. Speculators on spreadcharts represent the large institutional money managers. We do not include the small retail speculators as their impact on the market is often negligible and the data noisy. I won't go into details here, because you can find more information about COT data processing in the tutorial to the Spreadcharts app. For example, one commonly used data product is the net positions. This is what it looks like for corn. The red curve stands for the hedgers and the green curve for large speculators. Even if you wouldn't know anything about the commitment of traders' data, you can easily spot the correlations between the curves and the price. But of course, we will explain everything. Let's start with the net positions you just saw on the previous chart. It shows us what type of positions dominate in a particular group. Its calculation is simple. Just subtract the aggregate amount of short positions from long positions held by a specific group of market participants. If the value is positive, the group holds more long positions than short positions. And if the value is negative, it holds more short positions. Let's get back to the corn chart and show only the speculators group. This blue line represents the zero level where the amount of long and short positions held by speculators is equal. When the green curve is about zero, they hold more long positions than short positions. When it is below zero, they hold more short positions. Easy, right? And now, focus on the extremes. We will start with minimums. I connected the local minimums in the net positions with the price above. It is clear that minimums in COT net positions correspond to the local minimum in price. When the speculative net positions turned up, a rally in price usually followed. So it's pretty clear the speculative net positions correlate positively with the price. Why is that? As we mentioned, the large speculators behave like trend followers. They accumulate their positions as the trend runs. Additionally, most of them can only go long due to regulatory limitations. The aggregate amount of long positions grows as more and more of them jump into the trend. Once there is no one left to buy, the uptrend comes to an end. But let's take a look at hedges now. It is immediately clear it works in the opposite way here. They accumulate the largest amount of short positions when the price is at local maximum. A downtrend in price usually follows soon after. On the contrary, net positions near the maximum usually mark an intermediate term bottom in price. Why is their behavior opposite to speculators? Well, as we said, their goals in the market are different. They are not interested in profit. As the group's name implies, they want to hedge the commodity price risk. When the price is high, it makes a great deal of sense for producers of commodities to sell short, distant futures contract to make sure they will be able to sell their future production at these prices. They are basically locking a good profit on their future production and hence opening a lot of short positions. Conversely, the processors and users of the physical commodity will not be interested in locking the price they buy the commodity for when it is too high. But when the price is low, producers are not interested in selling their future production at this price, while the processors and users buy massively. That's why hedgers' net positions peak when the price is low. If you wonder why the hedges stay negative nearly all the time on this corn chart, it's because producers dominate users and processors within the hedges group in this market. Most of the time, net positions are fine. The simplicity is their indisputable advantage, but we will show you one more data product that might be better in some situations. It is called the COT Positions Index. Its formula is only slightly more complicated than net positions. It is calculated by taking net positions and dividing them by the sum of both long and short positions in a given group of market participants. As the formula suggests, it shows how far the market is from the balance on a relative basis. When does it make sense to use this indicator instead of just net positions? Basically, every time you analyze long-term data. Net positions are fine, but they do not take the overall market size into account. The problem is that nearly all commodity markets were much smaller in the past. They became bigger with the introduction of electronic trading in the first decade of this century and later with the explosion in retail trading. Let's consider the following example. Net position stands at 50,000 contracts, but this can indicate two entirely different market situations. There can be 650,000 long positions and 600,000 short positions. That's a pretty balanced state, as the number of long and short positions in a given group is rarely equal. On the other hand, there can be 80,000 long positions and 30,000 short positions. This would be an entirely different situation. Basically, a market dominated by long positions. We need something to take the total amount of positions within a given group into account. And that's what the COT index is good for. You might wonder when it is better to use the COT index instead of net positions. The answer is simple. The market size is changing all the time, but this impact is not significant in the short term. So if you are analyzing COT data over the past 2 or 3 years, it's fine to use net positions. In fact, this is what you will be doing most of the time. However, the COT index is definitely better when you are interested in long-term analysis, like more than 5 years. And here is the corn chart during the same period as before, but this time with the COT index displayed. As the calculation implies, its value can oscillate between -1 and +1. When it hypothetically gets to +1, the group holds long positions only. When it falls to -1, the group has just short positions. In practice, it's best to compare the current value with the past data to identify extremes. There is no difference in the analytical process compared to net positions. Let's show just the large speculators. In this particular example, we can say the COT index at or above 0.4 can be considered extreme. The market would be overbought in such conditions and vulnerable to a sell-off. And now, summarize what we learned about the commitments of traders' data. There is no doubt it is a helpful tool. It allows you to look into the cards of big players in the market. Do you remember how we described the farmers and other professionals dealing with the physical commodity? We will never have the information they possess or their experience. Luckily, it doesn't bother us, as we can see what they are doing with their own money and adapt accordingly. The data from the latest COT report is not enough to perform the COT analysis. We need to know the net positions or COT index development over time and compare it to price. We can find all of this in the Spreadcharts app. But enough with the theoretical stuff. Let's focus on the purely practical things now. We will devise our first trading strategy that is suitable for beginners. It will be a simple yet a real strategy that can lead you to success in the markets. We will begin with a few tips. We recommend you start trading just one commodity group and stay with it for many months, even a year, until you master it. Grains might be the best option, as these are the most liquid agricultural commodities. And importantly, you can find some low-risk interdelivery spreads there if you stay within a single crop. It may not be obvious, but it is hard to focus on just a single commodity group. You will see opportunities everywhere. Some of these markets might rely, and some people on social media will be boasting about their alleged profits. It takes a lot of discipline not to jump into other commodities or asset classes. Yet if you do so, it will most likely lead to losses and your trading system won't be ready, and other commodity groups like energy or metals are riskier than grains. Resisting these temptations will prepare you to face tough times in the markets. The second point is to focus mostly on bear spreads. Statistically, commodities spend most of the time in contango, and that's the best environment for bear spreads. Trading bear spreads provides you with a statistical advantage. Of course, these spreads usually profit when the underlying commodity moves slower or at least sideways. But commodities also tend to rally. Therefore, bull spreads are an indispensable part of every trading system, despite being deployed less often than bear spreads. The problem with bull spreads is that you need much more precise timing and generally have to do many things right to make a profit. Their win rate is usually low, which means you will lose money most of the time with bull spreads. On the other hand, they have a great expected risk-to-reward ratio, which means that when you put them on at the right time, the profit can be really huge. Of course, it is harder to manage such a strategy compared to bear spreads. But once you have your trading system ready, try to fine-tune it and incrementally improve it. You should start at a demo account where the mistakes would cost you nothing. Nevertheless, trading with real money is an irreplaceable experience. Of course, doing so makes sense only once your strategy and trading system are perfect. One mistake every beginner makes is overtrading. There is no need to be in the market all the time. Even watching the trading platform and the market prices constantly is counterproductive. Less is sometimes more. Focus on the best opportunities and don't worry if you miss some good trades. The market will always offer you new opportunities if you are patient. Make your trading as systematic as possible. Create simple rules and write them down preferably. Never ever break these rules. If you feel that your strategy is no longer optimal and needs improvement, do so only after thoughtful research and backtest. Never ever alter your trading rules if you are in a trade. And finally, one thing that can help you to learn from your mistakes is to keep a trading journal. It can be really simple, just a simple spreadsheet. It can help you spot errors you're making that you wouldn't realize immediately. Once again, be systematic. That's our advice on how to start trading commodities. And now, let's build a simple strategy as we promised. We start with a COT analysis to look for overbought or oversold markets. Step number 2 is the technical analysis of the underlying commodity. The goal is to look for support, resistances, and important trend lines. If you find something interesting from both COT and technical perspectives, take a closer look at the term structure of the commodity. Identify the suitable combination of contracts if you want to trade a spread, or just an outright contract if you are going to ride the underlying commodity. The next step is the seasonality analysis of the spread or outright futures contract. As we said before, it is not a cornerstone of our strategy. Sometimes it is even sensible to make counter seasonal trades. This usually applies to bull spreads. Once you accomplish all these 4 steps, make a technical analysis of the selected spread or contract and look for potential entry points and assess the undertaken risk and potential reward. So, what do you think about this strategy? Straightforward and easy, isn't it? Let's demonstrate it with a concrete example. As we said, it is best to start with grains, so let's stick to them. Here is a speculative COT index for corn. By the way, the top subchart shows the first continuous contract. These time series are explained in the spread charts app tutorial. You can think about it as a benchmark for the corn price. We will consider only bear spreads for simplicity. That's the strategy you will trade most often. So let's find some overbought extremes. I would say that if the speculative COT index gets above 0.4, the market is interesting for us. Of course, this is subjective as there is no precisely defined level determining the overbought conditions. Moreover, the market becoming overbought does not mean we trade it immediately. It just creates favorable conditions for bear spreads and incites us to analyze it further. But there are not just speculators in the market. The hedges are equally important. Here we search for extreme minimums when we look for overbought market conditions. I would say the values below minus 0.3 satisfy this condition. But once again, someone else might set this level slightly differently. And here you can see both groups at the same time. I highlighted the COT index thresholds we selected by these blue horizontal lines. Notice this situation in 2018 when speculators were over 0.4 and hedges under minus 0.3. Let's zoom in. This is how we would see the COT index data in spring 2018. COT index for both groups is beyond the extreme levels we specified before. We can conclude the COT analysis with a clear bearish signal for corn. But before you become eager to short it, we must clarify one thing. The commitment of traders' data is a poor timing indicator. It only tells us the market is stretched in some way. We must always combine it with other tools to identify an actionable trading opportunity. For example, the COT confirms the market is overbought in our situation on corn here. But in reality, overbought markets can become even more overbought. But once the market really turns around, the rapid closure of these excess positions will accelerate the move lower. Well done, that was our first step. We came to the conclusion that corn is overbought, and now let's do the technical analysis of the price itself. Take a look at the stop subchart with the corn price. You can notice that the price was close to 400 cents per bushel at the time. We can draw a horizontal resistance trend line here. Why? First of all, it is a round level which acts on its own as a psychological barrier. Moreover, the price failed to break above it in July 2017. Given the overbought conditions, there was a decent chance it would also fail this time. At least it would not break it immediately. Additionally, there is a second trend line connecting the lows from 2016 and 2017 that turned into resistance in spring 2018. So we have two trend lines above the price. I think we can conclude that technical analysis is also bearish. Don't get me wrong, even such strong levels can be broken eventually, but when the market is overbought, it is quite unlikely it would smash through the resistance immediately. It usually needs more time to consolidate and wear off the overbought conditions before continuing higher, or it can simply turn around and move down. Both of these scenarios are favorable for bear spreads. But the resistance does not have to be a precise level. For example, I have the price chart for July 2018 corn futures, which was the most liquid contract back then. Assume the price breaks above 400 cents. If it happens, the July contract price might get stuck in this congestion between 397 and 415 cents, as the price spent a lot of time there over 2016 and 2017, and the market would be really overbought if the price gets there. So the resistance does not have to be a sharp level. It can be an area. Okay, we are done with COT and technical analysis. It looks really likely that corn price would turn lower. So now we can step to the selection of suitable contracts for interdelivery spread. The term structure chart is ideal for it. We already know how to read the term structure. The contract from December to July next year belong to a single crop. We highlighted them here using the green circle. It is much less risky to choose contracts within a single crop, and that's what we are going to do. We would pick the widest possible combination, July 2019 and December 2018. By the way, this is the favorite combination of most traders as it spans the entire crop season. If we go back to our strategy, we made it through the first, second, and third step. COT analysis, technical analysis, and term structure. But before we walk about seasonality, let's repeat what we know about assembling a spread from the previous lesson. The plus or minus sign determines which contract we buy or sell. We prefer to write the contract we buy first so that we can omit the plus sign. If we want to create an inverse spread, we flip the position of the contract. But this is just a convenience. You can write the contract in whatever orders as long as you get the signs correct. As we expect corn price to fall in our example, we sell the closer contract as it is more sensitive and buy the more distant contract as a hedge. In other words, we create a bear spread. We selected the July and December expirations, which is the widest possible combination of contracts within a single crop. Our bear spread is, therefore, July 2019 minus December 2018. Remember, it is essential to pick contracts within a single crop season. This is how these bear spreads work the best. The reason is visible on the term structure chart itself, where all these contracts from one crop are in a perfect contango. And as we said, that's the ideal environment for bear spread strategies. You can notice there can be backwardation between different crops. That's not uncommon as these different crops tend to act as somewhat different commodities. So if we chose contracts from two different crops for our spread, it would be much riskier. If you do not believe me, check out price charts for various spread combinations in the Spread Charts app. Now we can move to the final piece in our strategy, which is seasonality. This is the stacked seasonal chart for our spread. You can see one abnormal year here, which is proof that seasonality can fail terribly from time to time. The steep fall in 2012 was accused by bad weather. I will hide this abnormal year now so that the prevailing seasonal trend becomes clear. I think the seasonal tailwind for this spread is obvious now. I highlighted it with this green arrow. You can also check the seasonal averages. I marked the start of a solid seasonal uptrend with this arrow. It lasts from March until October, which is remarkably long. While this is a strong argument in favor of this trade, keep in mind you are looking at historical data. Don't build your strategy just on seasonality, no matter how good it looks. The year 2012 from the stacked seasonality chart should act as a warning. Let's add the price of our selected spread, which is this blue curve. It's immediately clear the strategy worked that year and the spread rose together with the averages. So, we just finished the overall analysis and concluded the situation was really favorable back in 2018. Now, we can proceed to the tactical evaluation. That means potential entry and exit points. There is not enough time to discuss it in detail, but briefly. When we were considering the spread in March, you can notice the support at 15 cents marked by the green line. And just a quick note, the support would offer an appealing risk to reward opportunity. We could open a position just above the support, knowing that a decisive break below it will likely invalidate the opportunity in the short term. Here is another chart where we added the price of the underlying commodity, specifically the December 2018 contract. It's a purple curve and you can do this easily in the Spread Charts app. And here's the strange thing. The price of the bear spread actually grew together with the underlying commodity between the end of March and the end of May 2018. But this is certainly not how things should be. We told you that bear spreads are usually profitable when the commodity price falls or moves sideways. However, usually does not mean always. When this odd situation happens, we say the spread diverged from the underlying. Spreads better reflect the conditions in the physical market and often lead the commodity price itself. And that was also the case in this example. Rising bear spreads indicate the market is weak and sooner or later the change will come. And it did. The current price fell off a cliff eventually. That, in turn, further supported our bear spread. So, we built our first simple spread trading strategy today, but I'm sure you wonder how much we have to risk in a spread trade. And equally important is the potential profit we can reach in each trade. These metrics will allow us to estimate realistically reachable annual profit in spread trading. Let's begin with the risk management. Interdelivery spreads have one tremendous advantage. We can customize the risk as we wish. That's not possible with outright futures trades where the minimum position is one contract. With spreads, the risk depends on the width of the spread and the time to expiration. Given the number of active contracts for each commodity, we can assemble many combinations of interdelivery spreads. If we want to create a low-risk spread, we select more distinct contracts that are not that sensitive to the underlying price movements. We would also assemble a narrow spread, which means the difference between expirations will be minimal. And, of course, we must not forget to stay within a single crop or season. There are even spreads with risk as low as $100 to $200. I must admit such a low risk is reachable only in a few selected spreads in commodities like soybean oil or corn during normal times when there is no panic like drought or trade embargoes. But it's doable. More common would be a risk of hundreds of dollars for grain spreads within a single crop. Still incomparably low compared to outright futures. But it is absolutely critical to understand things like term structure, crop seasons, slaughters, etc. Basically, the things we explain through this workshop. The truth is not all the spreads have low risk. If you assemble the spread incorrectly, you can end up with a risk of thousands of dollars even in grains. This is usually the case with wider spreads across two different crops. On the other hand, if you understand the spreads, commodity trading can be much more pleasant. Now let's talk about the profits. How much I can make in spread trading is one of the first questions beginners ask. Well, there is no universally correct answer. You can make 10% a year or even 100% a year. It all depends on the risk you are willing to take. And everyone has different risk tolerance. So this is very individual. A trader can pick only the best opportunities where the expected risk to reward ratio is about, for example, 1 to 3, but it can result in just 2 or 3 trades per year as there are simply not many such great opportunities. Someone else might take a wider range of opportunities and maybe reach a higher profit, but this would be compensated by higher risk. Money management is also critical. It is the way we size our positions and whether we enter and exit trades gradually or at once. This all matters. There are plenty of variables. You can explore the possibilities yourself. Just go to the Spreadcharts app and use the dollar calculator tool to assess the risk of various spread combinations. But I will not avoid answering the question of potential annual profit. I mentioned 100% per year, which surely caught your attention. Someone can make this in a year if he or she is lucky. But I must strongly warn you about trying to achieve such profit. The undertaking risk would be so high that you would certainly lose all your money sooner or later. Some people tend to boast about the high return they made in a short period, but it is unsustainable over the long term. Please don't fall for this trap as it is dangerous and always leads to catastrophic losses. In our opinion, it is realistic to aim at 20% annual return in spread trading. If you don't like stress and want your trading to be conservative, you can target 10% per year. You would pick only a few of the best opportunities each year and sleep well. Moreover, the margin for interdelivery spread is low, so you can combine it with other trading styles or have the bulk of your cash parked in interest-bearing instruments. That way, your total return would be higher, and 10% just from spread trading would not be bad at all. And if you want to be more active, take a wider range of opportunities and accept higher risk. 30% per year is achievable under such conditions. Of course, you can make more in a single year if you are lucky, but you can also have a bad year. So we talk about the return that is realistic to achieve repeatedly. Making 30% per year is extraordinarily high. Aiming for anything above that is not a good idea. The conclusion is that expected return is always a function of undertaken risk. There is no free lunch, especially not in financial markets. And we are at the end of this lesson, which was long and extensive, but I believe full of helpful information. See you in the next lesson of this workshop, where we will extend our strategy and look at examples of real trading opportunities. Thank you for your attention, and bye for now.